Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Dennis Dick, and we have Tim Anderson on the line. He's a managing director at TJM Investments, speaking us from the floor of the New York Stock Exchange. Tim, how you doing this morning?
I'm good, guys. How are you?
We're doing well here. So the end of the first quarter here, we're coming in. Little window dressing. I mean, we're kind of in the middle of the trading range, so you can't really say there's like huge profit taking, or is there any particular stocks that the funds are going to want to show in their portfolio? Give us your take on the end of the first quarter.
Well, we saw some of that last week. Monday we were within a couple of good hours of all the indexes trading to new highs. And then some valuation reality set into the biotech stocks. That selling spilled over into a couple other areas. The semiconductor stocks were particularly weak. And then the market had three pretty bad days. Friday was a little neutral, managed a small gain at the end of the day. So now we've gone very quickly from the very, very top of the range to kind of slightly below the midpoint of the range, much closer, almost closer to support than resistance on where the market's been for the last few months. So now you've got kind of a funny week, because you've got 4 days this week. You've got 2 days at the end of the quarter. It wouldn't be, and the futures are looking up this morning, it wouldn't be surprising to see, a bump the last couple of days at the end of the quarter, particularly that we're closer to support than resistance. And then typically you get a lot of new money right at the beginning of the quarter, because people just, the dividends come in, and there's some auto invest programs that take place, and typically the first day of the month or the first day of the quarter is strong. It hasn't always been the case, but the bias is that way. But the wild card is, you've got this, because of a quirk in the calendar, you've got this March non-farm payroll and jobs report coming out Friday morning at 8:30, and the equity markets are closed. So it'll be very curious to see how investors position themselves, the first couple of days of the second quarter, while knowing that they've got a big unknown coming at them on a day when they can't react to it for 3 days.
And let's look at some of the winners and the losers from the first quarter. Let's start with the oil patch here. Some of your big oil stocks, ExxonMobil and Chevron Corporation. Exxon, starting the year at the $93, $94 level, now back under 85. Chevron, there's some of your losers. What are you looking for them in the second quarter?
It's really tough, because they're going to be a function of the price of oil, and you've got a lot of uncertainty. The uncertainty in the Middle East even seems to be increasing, not stabilizing, with all the action in Yemen the last week and a half. There are some very, very smart people that think that oil is going to break 40 and go down into the mid to low 30s, and there are some very smart people that think we've seen the lows and we're going to head back to the high $50, $60 range. So, anybody that can tell you where the price of oil is going to go with a fair amount of certainty, and nobody really can, that's going to have clearly a big impact on, that's going to be the driving force in those stocks. You had this situation a week and a half ago in some of the secondary names like Whiting Petroleum, where it had traded, bottomed out around 25 to 30 in January, had rallied up to 38, 40, traded even 41 a week and a half ago on some speculation. And that didn't play out, and they did a secondary priced at 30 off a $38 last sale. And that kind of woke people up a little bit to some of these secondary and tertiary names are really potentially going to need capital, particularly in the fracking space, if they don't run into a big, deep-pocketed partner that just wants to take them out.
And that's the scary thing in some of these smaller companies that may need the capital. Is that why you see stocks like ExxonMobil, Chevron, ConocoPhillips? They've held up fairly well considering oil's gone from 90 to 40 because those companies can
Absolutely.
survive at 40, correct? They can probably
Absolutely.
survive at
Absolutely.
30.
You know, they can,
Yeah,
they can, they can, they can deal with it. They've got,
yeah,
you know, a lot of different things going on all over the globe. And you know they'll be long
they're
term
fine.
survivors. No way around it. I mean,
But
you know,
it's some of those smaller companies that might not survive if we stay down
and
here at
Whiting.
40
There's
or
no
30.
doubt that Whiting is viewed by the people that know that company as one of the best operators in their space.
So,
But
so but they still need
they
capital.
needed to
That's
raise capital, and
right.
the real buy is worth a $30 level.
That's a good way to put it. Okay, winners in the first quarter. I mean, I guess you could look to Apple. Good reason for that. You know, blockbuster numbers, iPhone selling like hotcakes. Did you see any profit taking or get a feel that there was some profit taking in this near the end of the quarter? And what were some of the other winners for the Q1?
Well, the biotech space certainly, and then you had some people, you know, commenting, you know, as the Nasdaq got to 5,000 a couple times. Look, we certainly don't have a bubble in the internet stocks. It's a completely different world than it was in March of 2000. But maybe we have a little bit of a bubble going on in the biotech stocks, although there seems to be appetite for some of the biotech companies from some of the mega global pharmaceutical companies. But, you know, if you look at the chart, you've certainly had some near parabolic moves in some of the biotech names. If, you know, that's an area where you got to be a little concerned on just kind of an overextended move.
Yeah,
Not that the right companies in that space don't have tremendous potential.
but you put that in perspective there. Biogen in 2010, which is over 5 years ago, was $50 stock. Now it almost was a $500 stock. So you're talking about stocks increased tenfold here. Great company. The question is it a little bit overdone here and overextended? And is it due for a pullback here to try to maybe let the valuation catch up with the company's fundamentals?
Right, and you know you have valuation corrections every once in a while in pockets of the market that might give the market pause and concern a little bit. You had that last July and last October in the social media space, and you know, and in some of the real high beta Momo names, and you haven't had those stocks really recover. GoPro, etc. But I mean, the market's higher. So,
Tim, what I found interesting here, and we were noting this last week, just with the quadruple witch there that happened there, a lot of stocks actually topped out that day, and we look at the biotechs were one. They opened all at the highs. I believe Biogen came out with good news on one of their drugs and opened up at the highs that day and started giving back. But I've noticed in the past, and I've been a prop trader for 15 years, a lot of times you see on these third Fridays or these option expirations or the quadruple witch, sometimes you see the market actually, those can be turning days and turning points, and it was for the biotechs, and it was for a few other stocks too. What are your thoughts here, first of all, on these quadruple witches? Do you notice the same thing that sometimes the overall market can turn on these days? And is this a concern?
Right, you're talking about March 20th, which was the Friday,
Yeah.
and the thing about that day was also the S&P rebalancing.
Yes.
So any of the companies that have had significant price appreciation, they're going to have a little bit higher market cap, so they're going to be a net add for index portfolios. So that's going to create buying in those stocks for those days, which also happens to be an option expiration. So that certainly fits in with your theme that those days could also be potentially a market turn.
Tim, now,
I mean, if you had net buying in some of the biotech names in the different S&P indexes, because there was probably a rebalancing not just in the S&P 500 but in some of the S&P sub-indexes also, then you're going to have any of those portfolios that own all those names have to increase their weighting in the stocks that have had the most price appreciation, and that's going to cause that final surge of buying on that day.
So that could be like your capitulation move where everybody gets in, and maybe that's the short-term top here.
A little bit, yeah, and then you have to consolidate that, over time, because there's probably some long only holders of those names that aren't necessarily in in an index portfolio that will say, well, this is great. I'm going to sell into this.
Okay, so we're gonna look at this a Q2, and the kind of the earnings seemed like they were pretty decent. Well, the second quarter coming up, but we're coming up for Q1 earnings. It seems like some of the companies were hurt by the dollar. Let's talk about some of those companies, like a Procter and Gamble, for example. They got whacked on the stronger dollar. Really haven't been able to distance itself much from the low. Do you think they're going to be able to digest the changes in currency and show a better Q1 than they did Q4?
You would think that these big global multinational companies that have massive foreign currency exposure to fluctuations in the U.S. dollar, that they should be sophisticated enough in their corporate treasury area to be able to hedge currency exposure and potential currency fluctuation in the foreign currency market. The foreign currency markets have almost unlimited liquidity. Certainly, the airlines have hedged the price of oil for many years. And you would just think that these companies should do a better job of hedging the currency risk, and I think that the currency move may have caught them all off guard. They may have not imagined that the dollar could have stayed as strong as it did. When the dollar first broke out of its multi-year downtrend back in July, that's when you had that July correction. And a lot of people said, well, the big multinationals are going to really suffer from this because now the dollar's not going to go down anymore. It's going to get stronger. But as it turned out, they really didn't have that bad of a third quarter. But then in fourth quarter is a different story. First quarter might be a different story. I think it'll be interesting with the PE trading at the PE for the market trading at now, like FactSet has it at 17.5. And that's up a year ago, maybe from like 15.5. But it's probably the only time that you've had some multiple expansion because of earnings as forward earnings estimates for the upcoming year coming down. Usually you get it from people saying, well, the economy is so much stronger, these companies are going to earn more money than what's expected, and we're going to bid them up a little bit, and then you get some multiple expansion that way. But this multiple expansion has happened from earnings. People are saying people have come down to $1.20 for 120 for the year for the S&P 500 from 130, and some people are even saying 120 might be tough. It might be 116, 118. A lot of that's dollar related. Some of it's oil. Some of it's related to the fact that a lot of the big oil companies aren't going to make as much money as they have. It'll be a little bit challenging for the market.
And we are coming out of earnings season here, and obviously at the back end of earnings season now. I mean, we're going to start getting fourth quarter there in just a few weeks with Alcoa here. But
Yep.
is that a concern here for you that earnings estimates are coming down, or do you just look at it, well, if earnings start coming down and the economy starts to look a little bit weaker, well, then the Fed will just push off raising interest rates and the market will go up anyways? Do you look at it from that perspective, or?
Well, that's the big question, isn't it? Will good news be good news, or will good news be bad news? I mean,
or is it all good news?
I think that.
What are your thoughts on interest rates?
I think the big CIOs at the big firms, the big guys that really make the macro decisions, I think they live in a reality right now where rates are going up. They don't know for sure if they're going to start going up in June or if they're going to start going up in September. But they're going to go up. They're probably not going to go up every quarter, 17 quarters in a row like they did with the Greenspan Fed from 03 to through 07 or whatever the exact time frame was when that recession bottomed out. But rates are going to go up, and we're they're not going to go up at a very, very steep pace, but they're going to start going up. They've been zero for 6 years. and they're going to go up, and we're just going to have to start to deal with it. Look at the utility stocks. Look at what the utility stocks have done.
They've been killed, really, in the
You know, now they were probably way ahead of themselves in December and then again in January. But they're probably 10% off their January highs. Their highs were probably. It's a little bit funny because those highs in the utility stocks were probably an aberration from massive buying. From what I understand, was Japanese pension funds. The Japanese pension fund said they could buy equities toward the end of last year.
Oh,
my understanding is they bought the utilities because of their dividend yield big in December and big again in January. Caused a little bit of a aberration to the upside. And now you've just got people saying, look, rates are going to go up. We don't know exactly when it's going to start, but we know it's going to happen. We're going to lighten up in this sector.
And the economy is cranking enough that you can do that. You think that the data, I mean, we had some durable goods that went great last week. You think that, because what would happen if they tighten rates and then they had to go back and do another round of QE? You think the data that's data dependent is coming out showing this economy is strong enough that it could handle a rise in interest rates?
I think so. Yeah. I mean, you're already seeing some. You're seeing some signs of it, even in Europe already, and they only started their QE, a month ago?
Yeah, one final stock for you here, Tim, before we let you go. Alibaba, been in a trading range here, just 80 to 85, 86. It looks like it's trying to show some life, holding on above 85 here. You got any take on what you've been seeing on the floor in Alibaba?
I think you've got a lot of people that if you bought the stuff, you've got to reverse the trend. You've got to have something reversed, because if you bought the stock after the IPO and you weren't averaging a position from the cost of the IPO, you're underwater in the stock. So now when you've got a situation like that and you've just got way too many people that are a little bit underwater, you're going to have continuing overhead supply until you get, on any move higher, until you get 3 or 4 big volume days and maybe a washout, a flush out, and something to change momentum, or some real blockbuster earnings reports or fundamental news out of the company.
We've been on the line with Tim Anderson. He's a managing director at TJM Investments. He's joining us from the floor of the New York Stock Exchange. Tim, thanks a lot. We're getting prepared here for the shortened trading week and Q1 earnings. We'd like to have you on again and get your take on it.
Thanks, guys. Have a great week.
Okay.
Thanks, Tim.